Welcome to Lease Endgame, Buyout or Bailout. In this video, we will walk you through how to decide whether to buy your leased car or return it with a practical, numbers-first approach. We will explore how to check market value, how to calculate equity, financing options for different credit situations, and how to avoid unnecessary debt. Let's get started. First, we will set the stage with a reality check comparing the buyout price to real market value. Next, we will run simple equity math examples. Then, we will cover financing strategies including banks, credit unions, lesser financing, and dealerships. After that, we will present a decision framework and a brief case study. Finally, we will discuss a debt-free strategy and check your understanding with quick quizzes. Now that your lease is ending, you face a key decision that can affect your budget for years. In this section, we set the mindset. Do not let convenience or familiarity drive your choice. Instead, let's rely on data, market value, and total cost. By the end, you will have a clear framework to choose between buying out or walking away. Before we proceed, this video is for educational purposes only and does not provide financial, legal, or tax advice. Interest rates, approval criteria, taxes, and fees differ by lender and location. Always confirm details with your bank or credit union, the leasing company, your dealership, and your local DMV. Use this video as a framework and verify all numbers for your situation. Next, let's anchor on a simple framework. Start by determining the true market value of your car using trusted sources and real local listings. Then compare that number to your lease buyout price. If the buyout is lower than the market value, you likely have equity, which can make buying financially attractive or create an opportunity to buy and resell. If the buyout is higher than the market value, returning the vehicle and shopping for a cheaper, reliable used car is typically the better move. If you need financing, shop lenders first and avoid dealer add-ons. This flowchart shows the decision path you will follow throughout the video. Then, to find the true market value, gather your vehicle's VIN, mileage, trim, and options. Check multiple valuation sources such as Kelley Blue Book and Edmunds, and consider tools like Carfax, history-based values, or regional equivalents. Obtain instant offers from places like CarMax, Carvana, or Vroom, and ask a few local dealers for quotes. Also scan local listings to understand what comparable vehicles are actually selling for. Adjust for condition based on maintenance records and wear items. Include taxes, registration, and any buyout or processing fees to arrive at a total cost. Finally, subtract total buyout cost from true market value to see if you have equity or a shortfall. Afterward, let's quantify with quick math. In scenario A, the buyout is $18,500. Taxes and fees total $1,000, and the true market value is $22,000. That yields about $2,500 in equity. In scenario B, the buyout is $20,000. Taxes and fees total $1,200, and the market value is $19,000, creating a negative gap of roughly $2,200. Numbers like these guide the decision objectively. Meanwhile, compare buyout versus return. Buying out lets you keep a vehicle with a known history and possibly capture equity if the market value exceeds the buyout price. You gain control of maintenance and resale timing, but you may need financing and could face higher insurance costs. There is also a risk of overpaying if market conditions have softened. Returning the vehicle allows you to exit a negative deal, shop for a cheaper and reliable used car, and possibly pay cash to avoid debt. The trade-off is investing time to find the right replacement. Additionally, if you need a loan, start with your own bank or credit union because they often provide better rates and more transparent terms than dealerships. In some regions, you can finance directly through the leasing company to avoid dealer processing fees. If you do use dealer financing, enter with knowledge of current rates and decline add-ons such as extended warranties or paint protection unless you have independently researched their value. A qualified cosigner can help you qualify and reduce the interest rate. Obtain 2 to 3 pre-approvals to compare APRs and terms. Finally, focus on total cost, considering term length, fees, and any prepayment penalties. Furthermore, this pie chart illustrates where auto loan costs tend to hide. The principal is the largest component, while interest can be a significant share depending on the rate and loan term. Taxes and DMV fees add to your out-the-door cost. Add-ons may seem small, but they can be overpriced and rolled into financing, increasing total interest paid. The visual reinforces why shopping for rates and declining unnecessary extras matters. Now here is a quick quiz. If your lease buyout price is lower than the car's true market value, what does that typically mean? Option A. You have positive equity and buying could make sense. Option B. It is always better to return the car. Option C. Dealership financing will be the cheapest option. Option D. You must extend the lease. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is, you have positive equity and buying could make sense. When the buyout price is lower than the market value, you may be able to purchase and either keep the car or resell it to capture the difference, provided that taxes, fees, and selling costs do not absorb the equity. Subsequently, consider the debt-free strategy. If you have equity, you can sell the vehicle and use the proceeds to purchase a reliable, lower-cost car with cash. By avoiding a new monthly payment, you free up cash flow for savings, investing, or paying down higher-interest debt. Choose a vehicle with low insurance, fuel, and maintenance costs to reduce monthly outlays. When your financial position strengthens, you can always upgrade later from a position of strength. Next, the timeline shows how to pace your actions. At 90 days out, review your lease contract and note the buyout, contracted mileage, and any fees. At 75 days, begin checking market values across multiple sources. At 60 days, obtain instant offers and seek pre-approvals from lenders. At 45 days, inspect the car and estimate any reconditioning costs. At 30 days, decide whether to buy or return. At 14 days, lock in financing or prepare the sale. On turn-in day, execute the plan and finalize the paperwork. Then, let's apply the math. Suppose the buyout is $17,800. Taxes and fees total $900. For an all-in cost of $18,700. Local market checks indicate around $21,200 in value, suggesting roughly $2,500 in equity before selling costs. If you plan to keep the car long-term and maintenance is solid, buying could lock in a low total cost. Alternatively, you might buy and resell to realize the equity, then purchase a reliable cash car in the $8,000 to $10,000 range. If the market value were below the buyout, the smarter move would be to return the car and shop for cheaper options. Now, for a second quick quiz. Which financing move best protects you from overpriced extras and higher APRs? Option A. Skip pre-approvals and let the dealer handle it. Option B. Get 2 to 3 pre-approvals, compare APRs, and decline add-ons. Option C. Always choose the longest term to lower monthly payments. Option D. Rely on a co-signer only. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is to get 2 to 3 pre-approvals, compare interest rates, and decline unnecessary add-ons. Competing pre-approvals pressure lenders to offer fair rates, and avoiding extras prevents your loan amount from growing and accruing additional interest. At this point, remember these key takeaways. Always compare your buyout to true market value first. Positive equity can justify buying or even buying and reselling. Shop financing with banks or credit unions before using a dealership. Decline unnecessary add-ons and focus on total cost, not only the monthly payment. Finally, consider debt-free strategies to build long-term financial flexibility. To wrap up, pull your lease contract and calculate the total buyout cost. Check true market value using multiple sources and instant offers. Run the equity math and decide whether to buy out, buy and resell, or return the vehicle. If financing is needed, secure pre-approvals and avoid add-ons. Finally, think seriously about a debt-free route to maximize long-term financial stability. Thank you for watching. If this video helped you, please like, share, and subscribe. Tell us in the comments whether you plan to buy out your lease or return the car, and what numbers drove your decision. Your experiences help the whole community learn.